Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, June 29th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I cannot give you personal investment advice. I am not a financial advisor. Please do your own due diligence. It's your money. It's your responsibility. Okay, before we get started, kind of an announcement. Had a pretty big life change recently that's going to free up a lot of my time. And so what I've decided to do, something I've wanted to do for a while, and I'm going to go ahead and give it a shot, and that is devoting full-time attention to uh, the Actionable Intelligence Alert newsletter, videos, content creation for all these things that we've been discussing. So what you may or may not like that. I don't know. You may or may not care. The weekly might be sufficient for you. But what I'm reaching out to the uh, listeners on is getting some input and some feedback on what you'd like to see, uh, content ideas, um, subjects you would like me to talk about. Is there sufficient interest in me bringing back and just having like a separate video just on some of the geopolitical and politics things, or the rant, as some people say? Now that I have time to actually put that together properly and not just as an add-on at the end, whatever you would like to see, please put it in the comment section below, and I'll take a look at it. I will commit to looking and considering every suggestion. I can't guarantee that I will do or execute every suggestion, but I will give it attention. And so this is the opportunity, kind of crowdsourcing AIA, if you will, and giving you guys an opportunity to tell me what you want to see, or what you think, what is popular and what is, there's no reason for me just to try to guess what content to make. You're the audience. This is done for your benefit. Obviously, I want to increase my reach and my scope. I've had, for example, I've had somebody that's recently looked at the videos and said, well, some of this stuff is a little bit over my head. So do I need to think about maybe doing more basic investing videos, something like that? I'm just using that as an example. So whatever you guys think, let me know in the comments. Again, I will take it under advisement, and then we'll try to improve. But I do have a lot of extra time now, so I plan on focusing on some health issues as far as getting back into shape and kind of drifting into semi-retirement from the real world. So I think this channel has a lot of potential. A lot of people seem to like it. Some people have said that they're not sure why it doesn't have a bigger audience. I think if I make more videos, get more content out there, including interviews, I want to interview people though that isn't on the interview daisy chain. I don't want to interview the same people that everybody's interviewing. So give me some ideas if that's what you're interested in, and we'll go from there. Again, trying to grow the channel, so help us out if you could. I know some people don't like when content creators ask for likes, shares, comments, try to get that algorithm going. But this is what we do here. We create content. We want more people to see it. And if you think this content's valuable and you enjoy it, then share it, like it, and so we can increase our reach. Okay, let's get into the weekly report. So this was off Twitter, and this is something I think is interesting, needs to be paid attention to. This is a title of this slide is "More Debt is Less and Less Effective." So one of the arguments that some people have made, some economists have made, is that we're shoving more and more debt, more and more printed money and debt into the economy, but getting less and less bang for our buck. And this is an example. As you see on the left, you have a red bar that says Q1 2024 increase in federal debt, billions of dollars. So in the first quarter of 2024, the federal debt increased by about almost $600 billion. On the right side is the green bar, and that is the Q1 2024 increase in nominal GDP, billions of dollars. So you're I'm not saying these things are exactly correlated anyways, but what we're seeing and what we have seen, or people have made the argument is that it's taking increasing levels of debt to get less and less economic activity, economic growth. And so the argument could be made that it's kind of getting into the realm of diminishing returns. And so we're getting into the possibility that we're going to have to increase the debt even more and more just to get less and less uh, economic growth. And that's not sustainable. That's not going to work long term. And I think, we've talked about this before. My view of the economy and is more kind of based on common sense or some Austrian principles. I'm not a Keynesian. I don't. The less amount of government spending and interference in the economy is what I would prefer. It doesn't matter what I prefer, though. This is what we have. So I think this is something to keep an eye on, because where's the economic growth going to come from? I think, as I've said before, the main thing that I missed, I think, last year when we were talking about the potential for a recession was the um, not fully understanding or appreciating the amount of fiscal spending that was going on from the government and how it was affecting and propelling the economy forward, especially in new construction of plant and equipment. The Inflation Reduction Act, aka i.e. New Green Deal. So I don't think I had a full appreciation for how much of an effect that had, and just the amount of money that had been given to people, just the general population, regular people, during as the pandemic response played out. So I think, again, those are coming to an end, and I think that this economy has to stand on its own. And now the subject of these interest rates that have been raised by the Fed, the lag effect of that is every month, every week that goes by, is becoming more and more pronounced. And so it looks like some things are starting to happen at the margin. So I think this is something just to keep an eye on. Again, this is not directly correlated that more debt means more economic activity, but I think that we have seen the spillover effects of more federal spending. It's not based on taxes; it's based on debt. Again, we are running currently at levels of deficit spending that would be comparable to what you saw in World War II. So that's not good. So this is from Top Down Charts. I get an email from these folks every week. They have a lot of great charts. This was from like a week ago, and so I went through this chart pack now that I have time to actually go through emails. And this is really something that I had an appreciation for, and I think I've showed this before in a different format. But we're talking about, again, Michael Howell talks about liquidity and monetary conditions becoming more loose. I do something similar. I look at global liquidity through the lens of central bank action. And as I have said since August or September of last year, central banks around the world have increasingly switched from a rate hiking cycle to a rate cutting cycle. And we've even seen some of the larger central banks from the G7 get into their rate cutting cycle. Now, again, these things have lag effects also. But what I wanted to point out here is the correlation between monetary conditions getting more and more loose and global manufacturing PMI rising. And you can see it. This goes back to 1990. It's not exactly, but it's pretty correlated. I mean, when you have more money going into the economy, you're going to have more economic activity. I mean, this is like, without getting into much detail, this is just like, 101 thinking about this. More money in the system, loans easier to get, lower interest rates, more liquidity, more economic activity, global PMIs go up. We've talked about what PMI is, Purchasing Managers Index. It's a way to measure economic activity. Again, you can go to the S&P, I think, owns this now, the PMI. It's kind of a registered trademark. but they have a website and they track services, manufacturing, country by country. So there's a lot of information around this. You can really distill it down, but this is just a global manufacturing PMI based on these, you know, this formula they use to calculate monetary conditions as to whether they are loose or tight. And you can see that monetary conditions are improving to move from a basically 30-year low and tightness to basically bouncing off the bottom and going higher. And you've seen how PMIs have kicked higher, and we're slightly above 50, I believe, is the last reading. I don't remember, but this is something to pay attention to. Again, changing of monetary conditions has a lag effect also, and that doesn't mean that if the U.S. heads, the U.S. is the big bazooka we keep talking about, and when's the Federal Reserve going to fire? The ECB already started their rate cutting cycle. I think there's really only two of the major central banks now, the Bank of England and the Fed, that haven't really announced rate cuts. Those are coming eventually, believe me. Again, another risk that's out there is as more and more emerging market and foreign central banks cut rates, including the ECB, and the Fed stays pat, the dollar was going to have a tendency to become stronger against those currencies. And that is dangerous to some of those economies that are over levered. So getting back to this, why do I bring this up? Well, if global manufacturing PMI is expanding, then that's going to be more demand for commodities, which will have the effect of possibly, it's not guaranteed. I'd probably have to go back and do some more work on this. I think now that I have time, I might look at some of these charts and see, what did prices for oil and copper do during these periods when PMI was accelerating from a bottom, or as monetary conditions improved. It might be a good, and I think U.S. Global Investors, I showed a chart maybe a couple months ago. They had done something similar at a basic level, but they had showed very, very clearly that as global PMI increases above 50, you do see certain moves in copper and gold, or copper and oil, and things like that. So just wanted to point this out. This is something we need to keep an eye on. So here it is, right? Commodities versus global manufacturing PMI. This is from the same chart deck from Top Down Charts. You can follow them on Twitter. You can sign up for their emails. This is where I get these charts. I want to give credit to all these great creators that are feeding us information. This is why I tell you that you really need to curate a really good X sphere or universe of people that you're following that can give you value. I treat a lot of these people as my analysts. These are my analysts that are bringing me ideas, making me aware of things. Obviously, I'm the ultimate arbiter of where I allocate my capital, but this is how one of the ways that I do it. People ask me, well, what do I do? I take in a tremendous amount of information. That's what a lot of the intelligence agencies do. You see these movies about spies and everything, but most of it's just going through reams and reams of data to try to find patterns and trying to find pattern recognition. So anyways, let's get back to this. Again, this chart goes back to 1997. You see global manufacturing PMI in blue. As it increases, what happens to commodities? They go up. So this is all logical. Again, it's not a one-on-one or 100% correlation. If I had a smart analyst working here, some kid that's good with spreadsheets and had data, I would have him or her figure that out. But we're looking at this. We're trying to get the general trends right here, guys. We're generalist investors trying to get general trends in right, and then allocate capital accordingly. Another chart that I thought was interesting, and I run this out to my Discord channel. U.S. asset classes valuation versus history. You see treasuries in blue, S&P 500 in black. You see above zero. Further you get away from zero, going north of that zero line is more expensive. Okay, right now you see bonds in blue are you have these things inversely correlated here, right? And you see something similar in 08, where you saw in that case where bonds were expensive, treasuries were expensive, and stocks were cheap. That was after the crash, right? You had the global financial crisis. Everybody rushed into the safety of treasuries as stocks sold off. Again, stocks became too cheap. The Fed came in, we know the history, bonds sold off, and stocks moved higher. So it's important to look at these things because things are relative, valuations are relative. And again, what's our motto here? My motto is I would like to look for things that are overvalued and sell those and buy things that I believe are undervalued. That's the best way to make money. Okay. That's the common denominator I found in all of the uh, investment books I've read or famous investors. I'm going to put a quote in the weekly email from Hetty Green. She was the Witch of Wall Street. I've talked about her before back in the 20s, and she came from a whaling family. There was no boys in the family. She took over the family fortune as whaling was dying off in New England, and she cycled it back into real estate, stocks. They said that she used to have a desk right there inside the Bank of New York, I guess, or one of the banks in New York. And you would just see her there. She would show up for work and be clipping her coupons literally off the bonds and redeeming them. And I read a book about her, and she had all kinds of real estate holdings. She would buy, people would bring her deals. And if it was cheap relative to, historical norms, or, that's what she said. I buy things that are cheap and wait for them to become, dear to other people. This is a common denominator among investors, successful investors. So this is what we're trying to adopt here. And so getting back to this, if we're looking for the Federal Reserve to possibly be cutting rates, I mean, I don't see them being the only central bank sitting there, not having cut rates while the rest of the world's in a rate cutting cycle. I just don't see it. The dollar will just continue to go up. It will cause problems in emerging markets and with other currencies. The euro will go down, the yen will go down. These things are already happening. And so at some point, and not only that, at some point we are going to have a recession. So in that environment, stocks will go down. We've talked about this before, guys. I need to do some work on this. When the Fed finally does get to the point where they've decided to cut rates, they're usually well behind the curve and the economy is already in a bad spot. And then stocks usually go down after the initial rate cuts. Okay. I need to go back and look at that, when the rate cuts began, what the market was, and then, kind of look at that vis-a-vis bonds and vis-a-vis resources, because that's going to be important on the timing of what we do. Again, I think we're getting to that point, and I think there's a lot of misinformation out there or assumptions around the fact that, well, when the Fed begins to cut rates, stocks are going to take off. That's not the historical norm. I think an initial period, as I said last week, where you will see all stocks go down. Remember, all of these stocks that we own that we're talking about that are value stocks or resource stocks, what have you, they're still stocks. And in a general market decline where the market goes down 30 or 40%, which is normal in a bear market, 25, 30, 40%, who knows? Especially when you're coming off a bubblicious conditions like this, the pullback is usually exacerbated to the downside. So you can see I think I saw an article by John Hussman out there yesterday. He's a perpetual bear. I get it. But he's not wrong that the market could go down 70 or 80%. In that environment, all 95% of stocks will go down. That's just reality. Now, the first ones to recover as the central bank comes in and reliquefies the system and throws everything against the wall to save the system, yes, the value stocks and the resource stocks will rebound first. But do you want a round trip of 50% decline? Again, I'm not saying that's going to happen. I can't predict the future, but I'm just telling you what a plausible scenario could happen over the next 6 months to a year. And so our treasury somewhere we can hide and actually get a capital gain. Remember, the further you go out on the yield curve, 10-year, 20-year, zero coupon bonds, when rates are cut and rates come down, the value of those bonds goes up, and you can get a tremendous capital gain. Let's say that the Fed cuts 3 or 4% over the next year. You could see a 25, 30, 40% gain in certain bonds, depending on how far you go out. Now, there's risk there. As somebody told me on the Discord, hey, what about inflation? If inflation comes back, are bonds going to go down? Yeah, these are risks. But, we saw PCE come in the day, and it looks like, that was showing that inflation had slowed down a little bit more. Let's put it that way. So I don't know. Again, this is risk. Again, you can just sit in T-bills because nobody's cut rates in the US. You're still collecting, in a money market fund, whatever you're getting. I haven't checked the rates recently. I've seen people on Twitter saying certain vehicles that they're in are giving them 5% or a little bit above 5%. But that's viable too. Now you won't get the capital gains. The on the short term treasuries, you won't really get capital gains, right? But the further you go out as rates come down. Another thing is once rates come down, those T-bill rates are going to go down, right? And so you're going to have to do something. So I think there's what I'm trying to say here is I think there's a possibility here for a trade over the next 6 months. And every time I mention treasuries as a trade, okay, and that's what they are, somebody will say and feel the need to point out in the comments, why would you buy bonds? The U.S. government's going to default. The U.S. government's not going to default in the next year or two. I'm sorry. I just don't see a scenario unless California has a massive earthquake or an asteroid hits in the middle of the country or the Yellowstone blows up. Okay, some cataclysmic event could blow up the treasury market. Yes, we are on the downward slope to eventually having a problem in the bond markets. It's not something that's going to happen in the next year or two, in my view. It's not, the probability isn't zero, but it's not 50% either. So yes, you do not want to buy bonds and hold them to maturity. That's crazy because inflation is going to eat you alive. But if you can get a 20 or 30% capital gain over the next year in treasuries, that could be the safe place to hide and ride out. I'm just suggesting. So Tavasta here, chart, US has never been more overvalued. Price to book, here you go. That doesn't mean it can't go higher. That doesn't mean it can't become more overvalued, but you have exceeded, going back at least to the tech bubble times of where the tech bubble. So you have this, double bubble here, echo bubble. So do we move higher? It's possible. Things, when they're bubblicious, can get even more bubblicious. But again, I think you're walking in front of a steamroller picking up dimes at this point. This is the S&P 500 now, guys, we're talking about versus the MSCI world index, excluding the US. So this is giving you a good picture of where the overvaluation is and where the undervaluation is. I've kind of been talking about this for a year. Some of the emerging markets I am in, they're doing decently. Some of the stocks we have in Latin American stocks. I have some airport stocks in Mexico. The recent elections weren't positive for that. But there are opportunities, I think, in emerging markets. So this is Robert Bryce. This is a guy that's on Substack. He's a very prolific writer about energy from a common sense reality point of view. He makes these great charts. I pulled a couple of his charts off his Substack. Full credit to Robert Bryce. Link in the description. I'll try to put links to when I have these articles or subscriptions or when they're available, because we should support these writers. They're doing a tremendous job. So he points out here, this is from an article where he reviewed the statistical review of world energy that came out recently, I think a week or two ago. And so he made a bunch of charts and wrote an article, which you should read if you're interested in this stuff, which you should be if you're an energy investor. But what he says is the world spent 4.7 trillion on wind and solar from 2004 to 2023. That's about 20 years, right? 19 years. Global spending on wind and solar was 4.7 trillion. Yet hydrocarbon use increased 3.2% faster. And so I was listening to Art Berman the other day too. He's another guy that's pretty prolific writer about energy. I don't necessarily have the same views as him. He's a little bit more, I think he's coming from a more liberal bent. I think he believes in climate change, let's put it that way. He believes on limits to growth and these things. I'm not saying he's a Malthusian. He's not. He's not somebody saying that we're going to run out of hydrocarbons, but he has said that one of the points he did make, which I knew, and Vaclav Smil has pointed out, and others, is that you're not going to replace. The history of energy transitions is not one of replacement. It's one of addition. Let me say that again. The history of energy transitions for human history is not one of replacement. It's one of addition. And so what we have seen, if you look at the charts and you look at I've put this chart up before, and I've seen it in other places. As man went from burning biomass, wood, animal dung into, like I said, wood, uh, you know, as an example, the UK was facing deforestation until the coal mines were discovered, and uh, wood wasn't replaced, but it coal took off then at that point. And as energy demand increases, it wasn't gained by wood. People still burned wood to a certain extent, but coal was more available and cheaper, and so its use took off. And we see that not only there, but the whole world. You see that these things are cumulative, okay? Because the energy use for people is boundless and infinite because people's needs and wants and desires are infinite. Now, that's one of the things Berman argues about, is that the world doesn't have the ability for everybody to have the same lifestyle. These are arguable things. Some people that are Malthusians and people that argue against growth, they will say that um, there's limits. But when you have a big population, you have more ability for people to be creative, more brain power, and more people to be creative geniuses statistically, and for us to solve the problem. That resource, you may say that there's a limited amount of coal or oil in a certain area, but it's not. The human ingenuity is limitless also to solve problems. That's what we have seen. Now, I'm not saying, nobody can really tell. This is like an ongoing discussion and argument that folks have. But for us as investors, and what's actionable is that hydrocarbon use is going to continue to increase. It's just that simple. Okay. And you can see it 2004 to 2023 pie chart where you see hydronuclear and biomass. Renewables really weren't a big thing then. And then you see hydrocarbon use was 384 exajoules. And then you see in 2023, 504. So the problem is that the total amount of energy that needs to be consumed continues to grow. And hydrocarbons actually have increased faster than these other sources. And so if you spent $4.7 trillion, so that's 6% of the energy use is from wind and solar. I mean, how many multi-trillions of dollars do you have to spend? It's just, and then that's just for one life cycle. Remember, guys, this is the argument that I have made against this and that other people have made against renewables. You don't just put like solar panels up and they last forever. They have a lifespan. As they're exposed to ultraviolet light and photons hitting them, they deteriorate over time. Their ability to generate goes down depending on the panel, depending on the technology. It can go down 1% a year or something like this. Okay. It loses efficiency over time. It's just like an oil well will go through a life cycle of increasing production, plateauing, and in decline. The reservoir is not infinite. These are machines we're talking about. Same thing with wind turbines. They're machines. They have a lot of stress on them. They don't last forever. And so as repair costs get to the point where it's not viable to repair, you start talking about replacement. And so you start having demand on bigger and bigger amounts of commodities. And this is where I think, as long as this continues, this view that we're going to do this renewable stuff and throw these hundreds and billions and trillions at it, that's going to have an effect on these commodity markets. And that's why, ultimately, as the global South and East and emerging markets, we've said this before, this is where our opportunity is for resources. This is why I believe in a super cycle. As this 4 or 5 billion people go through their S curve of entering middle class and industrializing and urbanizing and all the things that go along with that, it's going to provide upward pressure on the demand for the resources. And yet we have many, many constraints, like we've talked about before: capital, resource, ability, labor on the supply. And so this is why we can talk about things from week to week. What did the price of oil do? What did the price of copper do? But I think, you know, ultimately, the longer term, at least in the 5 to 10 year period, is upward. So here's a chart where he says just stop oil. Global oil demand is going one direction, up. Global oil use averaged 100 million barrels a day in 2023 for the first time in history, and it continues to go up. It goes up by about 1 to 1.5% a year. There's been, I think, 4 instances in the last 50 years where oil demand has dropped. That was like the pandemic, global financial crisis, I think the Arab oil embargo. I mean, these are like asteroid type events. Okay, so even if you have a recession, yes, it may not grow as fast, but ultimately it recovers and keeps moving higher because we've talked about this, other people. So you can't really just focus on what the EIA says in their weekly things in the US and base it's what's happening around the entire world. Okay. That is important. So the thing that people forget, and I've mentioned this in the last couple of weeks, and I'll mention it again, remember, all of these resources are priced at the margin. Okay. So it's just, again, a slight, so people say, well, I don't understand, if oil prices go up every year, how come the price of oil doesn't go up? Because when you take everything, all of the inputs to the price, demand, supply, if you have slight periods of oversupply, it doesn't have to be that much. In the context of 100 million barrels, a 500,000 barrel or 1 million barrel a day surplus can have a very big effect on the price downward. Okay. Conversely, if you have an undersupply of very little, that can affect the price upward because these commodities are priced at the margin, guys. So you have to look at it longer term. You have to look at it beyond just, this is where you're at. And we're kind of in a sweet spot right now. With oil at $85 Brent, there are plenty of companies out there that are minting cash. Okay. They have oil fields and resources and assets that cash flow very nicely at these prices. And so again, we're still in that phase, for example, where shareholder returns have taken over from drill baby drill. And so that's why we're seeing a lot of companies saying, hey, when we get this debt paid down to this level, we're going to devote X amount of free cash flow to buybacks and dividends. And we're seeing that all over the place. And that's why we're interested in some of these stocks, especially like in the Actionable Intelligence Alert newsletter dividend portfolio. Okay. We have very large cap, mega cap oil companies in there because they're doing the right things to focus on cash flow and increase that cash flow and pay out dividends and do massive stock buybacks. That's what we want to see. We want to see, as a shareholder, we want to hold a share of those cash flows, and the managements are responding in kind by returning that to us. And that's a sweet spot we want to be in. That doesn't mean that the dividend portfolio is going to go up by 5 times, but we're going to get a nice dividend, nice payment. Okay. But we also have the potential for capital gains as the stream of cash becomes more valuable over time and it's recognized. And so the potential for the stocks to move higher as they reduce the share count and raise dividends, that could boost our returns. So I wanted to talk about this. This was a chart. This is talking about 70% of new horizontal wells are child wells. So what we're talking about here is you drill a well, a horizontal well. It's a parent well. It's the first well in a reservoir. And then you do what's called, and then maybe you go to the other end of the reservoir and put another well in. Okay. And then you start doing infill drilling. You start drilling wells between them. And those are called child wells. I'm explaining this basically. I'm not a petroleum geologist. I'm sure that if there are any listening, they can add in the comments if I'm missing anything. But what we're starting to see is we're seeing less and less parent wells, and now 70% of the new wells are child wells. Well, there's a lot of, you really have to know what you're doing. There's a lot of potential downside, right? Because if you put a child well too close to a parent well, you can affect both wells. You can negatively affect the reservoir. So what I'm trying to say to you is a lot of the easy, when the shale revolution began, whatever it was, 15 years ago, whatever, it was just easy just to put a well in the ground and make, and have this thing flow. Now it's getting more complicated. It's getting more difficult. And what I'm ultimately getting at is, are we reaching a point where we're going to plateau in oil supply growth in the U.S. from the shales? I think we're seeing that already. That's an argument that several analysts are making. And if that's the case, because U.S. shale was the supplying all of the supply growth for the last years, and if it's now plateauing, that could be a problem for the world, because as supply now plateaus and demand, as we just talked about in a previous slide, continues to go up, that's where you start running into imbalances. Again, these are very complicated issues, so we're looking at them just in general and what the potential is. But you see that in a lot of these areas, you're up to, in the Williston, 90% of the new wells are child wells. So you're seeing overall in the lower 48, you're up to 70%. So you see the Permian is at 75%. So it's going to be interesting to watch what happens. I'm not suggesting that U.S. oil production is going to collapse. All it needs to do is plateau, and that will be a problem for oil supply over the next few years. That's my argument. So this was a Reuters article. Again, this is just another brick in the wall of the bullish uranium story. This is not a singular event that will catapult uranium to record prices, but again, positive. U.S. to start buying up to $2.7 billion in domestic nuclear reactor fuel. The U.S. is bidding to eventually buy up to $2.7 billion of domestically supplied enriched uranium in an effort to boost the supply chain for the nuclear reactor fuel and steer the country away from buying it from Russia, the Energy Department said on Thursday. The Department of Energy plans to award 2 or more contracts which will last up for 10 years, depending on the availability of funding. The sources can include new enrichment facilities or projects that expand the capacity of existing enrichment facilities. The move could benefit Centrus Energy, opens new tab in Urenco, that was an editorial thing, opens new tab, sorry, could benefit Centrus Energy and Urenco, a British and Dutch German company with operations in New Mexico. Proposals are due August 26. I'll put a link to the article. So we've talked about this before. This is really one of the only bipartisan things that's actually happening in our government. So it's beneficial for us as far as, again, the whole thought process and thinking around nuclear power and how it's now being pushed to the forefront as a solution for climate change. Obviously, I'm not sure that the powers that be care about climate change. They want to be able to power this electricity demand that's supposedly going to come from AI and data centers. They say climate change because, that sounds good. So I wanted to point this out. This is a TSX venture exchange. This is a tweet. Somebody pointed this chart out. It's a ghost town. And so what you see is the venture exchange composite index going back to 2007 when it peaked at above 3,200. It's now at 600. It looks like an EKG of somebody that just had a heart attack and is dying. The other thing I would point out is volume. There's no volume. So why do we care about this? Well, we care because the venture exchange is where a large proportion of resource stocks are traded. And the reason why we haven't really seen a big response, I think, in resource stocks, even though we've seen gold move very high, we've seen other resources move, copper, oil, what have you. With a few exceptions, we really haven't seen, like, if we're in this new commodity bull market, how come these stocks haven't moved? And I think one of the things to consider, which we've talked about before, is where's all the attention? We're in a bubblicious economy with tech in a bubble. with everybody focusing on AI and NVIDIA and chips and all that stuff. So all the money and all the action, and that's the shiny object. That's where the FOMO is. And so who's going to go buy some gold stocks or some junior oil exploration company? There's no volume, there's no cash, there's no push here. So you might ask yourself, okay, so I guess I should go buy tech stocks. No, I look at this as being a contrarian dream. We've had multi-years here going back to this thing really can't get going. Since the peak at the great financial crisis, we had an echo kind of mini boom on the TSX in 2011, but it's been sliding down and then kind of going sideways here with a few little bumps here and there. And so I think it would behoove us to watch this and not only watch the price of the TSX, but watch when volume. Eventually the tech bubble will reprice downwards. These things always do. And then where will capital flow? My suspicion it's going to flow to undervalued assets like the resource sector and value stocks. And so this can be a great indicator for us of when that's happening. That's why I think there's really no reason to go rushing in headlong, full steam ahead, because I think you can use some indicators like this to kind of figure out when this is starting to happen. When you're going to have to see the tech, you're going to have to see a tech wreck. You're going to have to see the bloom come off the rose, and then you will see a massive capital shift to other sectors. And I think this sector, the resource sector, the junior resource sector, will eventually get up off the floor and be resurrected. Now, you will probably see, if history is any indicator, you will see the large cap resource stocks move first, because smart money, institutional money, big money is not going to go buy some junior resource stock that has no volume and can't really have an effect. You'll see people moving into Newmont. That's why you had like Stanley Druckenmiller and these people buying like Newmont and Barrick and stuff like that. That's where the smart money, that's where the early money goes, into the large caps. But once you get a trend in place and starting to be acknowledged that that's where money's going to shift to, then you will see it filter down into these juniors, and that's when you'll see the TSX do well. So again, no hurry. It's something to watch, put on the watch list, look at it, every couple weeks, see if it's if there's money flowing in there. Again, I think one of the first things that needs to happen as a precursor to that is you're going to have to see the tech sector kind of top out and go into decline, and then money will come out of there and it'll be looking for some place to go. Maybe it's going to be long-term bonds if we're going to go into a recession for that trade I talked about earlier. Eventually, I think we make it into this sector. We have another boom here. But again, you can't know the future. We've been talking about this for years, and it really hasn't happened with the exception of a few sectors here and there like uranium. So I just wanted to point this out. So this is a guy I just came on Twitter, Christopher Aaron. He basically had a pretty good tweet I ran into. I have to do some more. He has a video where he talks about this. I'll throw it up in the video in the weekly email that comes out early next week. But he's making the argument that gold mining sector is valued at less than it was when gold was at $250 an ounce. And so he says a couple slides here for his tweet. The gold and silver mining sector is currently valued less than it was in the year 2000, when gold traded at $250 an ounce compared to the rest of the U.S. economy. Ratio between real asset classes, mining as compared to the S&P 500, cannot go to zero. That's true. Yet this is the closest to zero that this ratio has ever been. And so he makes a couple of points here. This is a follow-on slide that I make because the tweet was really big. He says from the 2011 gold peak, when gold peaked at $1,920 an ounce, the XAU S&P 500 ratio was 0.20. He says from the current ratio of 0.025, the average gold miner would need to rise by 700% and or the U.S. stock market would need to decline by 87.5 just to get back to the ratio that it was in 2011 when gold was at 1920. So do I think that gold stocks are going to go up 700% and the US market is going to go down by 87.5%? It's possible. More than likely, it'll be a combination of both. The US stock market will come down. Eventually, you'll have a bear market, and gold stocks, gold miners would go up. It'll be several hundred%, I'm quite sure. It's very possible it could be 700%. It could be more. It could be less. But the point being made here is that you are at extreme undervaluation relative to historical what's happened in the past and relative to where the money is right now. All the money's in tech. Everybody's following the shiny object. Everybody's got the FOMO. That's not where you want to be. 1980 gold peak, $850 an ounce. We had a XAU was at 1 as the ratio was 1 as compared to the S&P. From the current ratio of 0.025, the average gold miner would need to rise by 4,000% and or the US stock market would need to decline by 97.5%. So again, I'm not suggesting, I don't think he's suggesting that it's going to happen like that, but what we're looking at is the extreme overvaluation in the overall equity market vis-a-vis gold miners, and that, at some point that's probably going to correct with a combination of the equity market as represented by the S&P 500 going down and gold miners going up. And with the amount of undervaluation and how long this has been undervalued, it represents a tremendous opportunity. Again, junior gold miners are burning matches. You can't just buy and hold them. So you kind of have to time this. You kind of have to say, that's why I think, watching the venture exchange, if it gets some traction and it looks like it goes into an uptrend, that could be your clue. You don't want to be early on these things because they're burning matches. They're not heirlooms. If you buy them too early, they're just going to issue stock. Price of the stock doesn't go anywhere. They don't actually have any cash flow. And again, that's what we say, they're a burning match. If you light a match and hold it, it'll eventually burn down and burn your fingers. So you don't want to be doing that. So you really, if you want to play in this sector, you really have to pay attention and get your timing right. You don't have to be dead on, I don't think, but you have to be pretty close, because these mining companies and these potentials of mining bull markets, they're not, mining's a horrible business, as we said before. It's a net destruction of capital. But there is periods of time where mining stocks can tremendously outperform. And so, but you can go back in history and look that up, but it's not a buy and hold situation by any means. Even though how juicy this is, you got to come up with some kind of formulation to say to yourself, okay, the odds are in my favor that this is actually a move in this sector, and I'm going to ride it. And I think you got to be pretty tight with your stop. So if it's not playing out, or if it turns down on you, you got to get out. You just can't let these things fossilize if you get it wrong in your account, because they'll just go down. These things can go down 90% or go out of business, and that you can't afford to be destroying capital like that. So this is from Katusa Research off Twitter, right there. You see it. Beware the CAGR projections. I've said this before. I'm not saying this won't happen. This is the global data center CapEx forecast, co-location, hyperscalers. Again, we saw something similar in EVs, right? That's the big thing now. Everybody says copper because we're going to have to build all these data centers, and electricity production and demand's going to go up. And if you look at the CAGR, this is going to, over the next 10 years, we're going to end up here. They say the same thing about EVs and other things. It didn't pan out. I'm not suggesting it won't pan out. I just say beware of linear or these kind of projections. Okay, because we don't know the future. Everybody talks about this power that's going to get built. I was looking at, when are they going to start building all the power plants? When are the transmission lines? I talked about last week where ERCOT here in Texas was talking about the amount of electricity doubling, I think, over the next 5 or 6 years, the demand. So what's going to happen? Is the planning in place, or are they going to have to restrict these things and say, look, there's not simply the grid can't handle it, and we can't have, households and other businesses going through blackouts so that we can keep these data centers sucking in power. So that's a real danger, right? Because is the power supply going to get built out? Is the transmission and distribution network going to be built out sufficiently in order to enable this? This is why Amazon bought that property right next to that nuclear power plant that we talked about a couple months ago, because they get this and they know what's going to happen, and that's why they want to be as close to the generation facility as possible and sign a long-term deal and then be sitting right there. You don't have to worry about, you're 50 miles away or something. You're right next to it, and you build a little extension of the substation right into your data center, and so you're set. So I think this is what a lot of people are focusing on, consultants and analysts. I'm not saying Catoosa Research is wrong here. They got their data from Bloomberg. What I'm saying is just beware of this, because sometimes we can't know the future. And obviously, if we're resource constrained or planning the grid and power plants, this is a lot of capital that needs, and so can you actually do it? Is it actually physically possible? Can it happen? I'm not saying it won't grow. It's obvious it's going to, but will it be at the scale that everybody's assuming it's going to be? Because you could be left disappointed. So I wanted to point this out, kind of get into some little bit of amusing things. Somebody pointed this out the other day. This was a tweet on, I think Larry McDonald put out. NVIDIA Corporation replaces Enron Corporation in the S&P 500. This was back in 2001 when Enron left the NASDAQ or the S&P 500 index, and NVIDIA came in. So we all know the story behind Enron. I'm not suggesting any nefarious goings-ons at NVIDIA. Some other people have concerns, I know, around the vendor financing and some of the financial eyebrow-raising financial relationships that NVIDIA has with some of its doing its vendor financing with its customers. But I just wanted to point this out because I thought it was interesting. We'll see, right? We'll see if history repeats. So I wanted to talk a little bit, we're getting into the political realm now. I mean, I think if you're this is in reference to the debate yesterday, couple observations. Did I watch the whole thing? No, I kind of was working on some other stuff and going back and forth. There was a couple key things in there I thought were, I made a couple observations on. Number one, I already was of the opinion that President Biden is, got some problems, whether it's Alzheimer's or some type of dementia. I don't know. His faculties have been deteriorating and continue to deteriorate. And so I think what has been suggested is a couple things. I don't think anybody at this point that's looking at this unbiased, and there's always going to be partisans that they don't care. They don't care if the guy just came out there and pooped his pants and, was drooling. They're still going to vote for him. They're still going to make excuses for him. That's fine. That's just how things are. I'm not that guy. I'm going to look at things for the way they are, or try to put my biases. A couple things. Why is his family allowing this? Well, I think you're dealing with people that have a different value system than most of us. They just want to be in power. They gain a benefit. They don't care. This is the Biden brand. Jill Biden's running Joe as far as handling him. I'm not saying she's making policy. She's not. But what I'm saying is that kind of goes to the question, who's really running the government? Who's making the decisions? In any administration, the president isn't making all the decisions anyways, but at least he's lucid and has people around him, and he's having some input. I'm not even sure he has any input at all at this point. I don't know what he's doing. So the question is who's actually making policy? Who are they? You always have that permanent state there of that bureaucracy, those mandarins that are there forever. They just go between administrations. They're always there, that permanent state. We know that. We want that dismantled, obviously, but this was really bad. And so, I really don't know what's happening, but, this is not good. You have there, it's 81. Then you have another guy that's 78. I will give Mr. Trump a couple of points because he really could have thrashed him hard. He thrashed him a couple times. There was a time when Mr. Biden said something about the border and it was all slurred and didn't really make sense. And Mr. Trump said, I don't know what he said. That last sentence, I don't know what he said, and I don't think he knows. That was kind of a zinger. That's what Trump is famous for. But he could have really buried this guy, and he didn't do it. I mean, this was a way different Trump than we saw during the last election when, it still was contentious, but it was just Joe Biden just saying stuff. You could see one time where he adjusted the earpiece, he was being fed information. This is bad. And so what you saw after the fact, I think, tells you what was about. I mean, all the news media within, minutes after this, I mean, there was already articles going up, tweets, the entire commentariat of the press, the Prov de Press was out there saying, this is terrible. The Democrats have to do something. This was kind of, I think, a way to do a soft coup. They got to get him out of there and get somebody else in there. And you see this, what I've shown you here is a chart. This is from the predicted market. This is a prediction website. You can go on there and people put real money up, and it's kind of a prediction market, right? It's a free market where people can bet on outcomes. And what you see here is you see that the night of the election, the volume you see spiked tremendously. That those blue bars are the volume. You can look to the left and see the volume. But what you see is the price. This is for who would be president. Mr. Biden obviously is the purple line that crashed last night. And Mr. Trump obviously went up. You see it's 90 cents. I took out, you can check different names. Governor Newsom also went up. So there's usually, if I put Newsom on here, you would see a red line going like this, and he was going up. So it looks like this is what we can expect to see. They're going to somehow, I think, try to, I mean, everybody has an opinion. No one can know the future, but it looks like they can't really run this guy who's, unless they're really going to have to ramp the steel up. And there's been a lot of names thrown out there. Who knows? Maybe he will end up being the nominee. I don't know what's going to happen. We'll have to see how it develops, but this was really not good. And if, you have these guys set up there, a 78-year-old guy and an 81 arguing about their golf handicap. I mean, really? We are on the verge of a possible war in Europe, an expanded conventional war, the possibility of it bleeding over into a nuclear exchange. We have the possibility we have Israel now saying they're going to go into southern Lebanon and attack Hezbollah. We have the potential for Iran to come in then in a wider Mideast war. And we're talking about golf handicaps. This is not a serious country, folks. This is not a serious country. This is not what people should be talking about. So, but this is what we have. And so that's my observation. This is what you see in late stage empire. Okay. And maybe this is the last throw of the dice for the baby boomers or what have you. And after this election, we'll have, Gen X and millennials taking over. I don't know what that means, but this is just an indication of the decline in not only in Mr. Biden, but the U.S. overall. And so this is it, and not much more to say. I don't really feel good. I don't want to sit here and bash the guy. I think all politicians need to be derided and criticized and made fun of when appropriate. But, somebody that's just being pushed out there that's in obvious advanced stages of dementia and just being used, he's not a good guy in my book anyways. Mr. Biden, his entire career, he's been kind of a joker, kind of a bum in my opinion. But this is like elder abuse. So anyway, we'll see what happens. I mean, Mr. Trump still has a lot of outstanding court cases and unknowns there. But you see what the predict market showed as of yesterday. The market reacted. The people put money up for their opinions, and this is kind of, I think, what folks were looking at. It gives you like an instant feedback before other polls come out. But I think this guy's done now. He's toast. There's no way, well, unless there's massive fraud, I don't think there's any way that Mr. Biden can win the presidency after yesterday. So we will see what happens. And there's still like, what is it? It's only June, so July, August, September, October, November, 5 months. So we'll see what happens. I'm already getting calls on my phone for people wanting to poll me on this. So all that's going to start ramping up. And so we'll see more of that, unfortunately. And then, so it's not optimistic long term for this uh, political class, I don't think. So anyway, that's it for this week. Appreciate the following. Again, we're going to ramp this thing up now. We're going to take it full time for some period of time and see if we can get some traction. A lot of people think that this videos and podcasts and stuff should get a bigger hearing. We're going to put more content out and see if we can make that happen with your help. Again, give me your ideas in the comments and we'll take them under consideration and apply them where we think that they make sense. Thank you for your support, and we'll talk to you next week. Thank you. Or soon, I should say.